All right, good afternoon, everybody. I'm David Huff, CPA here, bringing you the June 23rd, 2023 edition of News from the Front Lines of Business by DW Huff Consulting. That will help you know your numbers so that you can grow your numbers. So here we are, Friday, made it through another week, and I was going to share some observations and information that has come up over the week with discussions with our clients as we kind of doing our thing here with our tax planning and financial consulting. But so the things I'm going to talk about this week, we had a few chats about cryptocurrency and who owns it and what's going on there. Another discussion on credit card bonus reward, cashback reward points and how you can utilize those, and infinite banking. So we'll just kind of jump in here. So on the first one here, cryptocurrency. So we know it's been in the news. It had a pretty substantial drop in value a year or so ago, and now it's rebounded somewhat, but definitely not anywhere near as hot of an item investment-wise as it was in 2020 and 21. So I'm kind of looking at it in my mind. So people are still investing in it. I think it's definitely cooled off. However, I'm just my doubts about this as an investment are the utility of it. So who is really using cryptocurrency? So I dug up a few statistics here, and we're seeing that currently in the U.S. we have a 13% rate of adoption. So that means 13% of the people have some kind of cryptocurrency in there, whether it be a wallet or some sort of exposure to it. And globally we're lagging a little bit, and I found it also kind of odd that India was first at 29%, and one of the other charts I looked at had like Nigeria and some other African countries coming in not too far behind India, which is kind of odd to me that these developing countries are having a higher adoption rate. So what's going on there with these less developed markets are leading the way in this coin. So I think what you want about that, but I kind of have my doubts as to the true viability of it. But here is one study. We had 33.7 million Americans having some cryptocurrency in their portfolio. So that's a pretty small amount in my opinion. Bitcoin's being the biggest one, no surprise there. Men are more likely to own than women, so I don't know, not too much surprise. And the fact that I find it to be a very low adoption rate. So here we are, several years down the line here, when post really becoming popular, and we don't really have a continuing surge of ownership. It seems to me like it's kind of plateaued. So here's another study here. So worldwide, there are 106 million owners. The people who use it daily, 400,000. So 106 million people have some. Only 400,000 businesses, individuals, whatever, are actually using it. And we scroll down a little bit further here, and the number of transactions per day is 270,000. So it's not taking off. I mean, it's not really heavily used as a mean of exchange. People are buying it, I think, in speculation of some type of growth that I'm just kind of skeptical that it's ever going to happen. It really seems like it's just not really taking off, and maybe 5 or 6 years down the line that will change. But we'll see. So, but as is now, I think the numbers are underwhelming, and so if you're going to choose to invest in crypto, do like I always tell you with restaurants and everything else, don't invest in the asset. Figure out how to make money on the people who are using the asset. So mining, staking, things like that are probably where the money is in crypto right now. Holding it as an investment, waiting and expecting it to go up when it's not really being used heavily, it's kind of a crapshoot. So do what you want with that information. All right, so little things adding up to big things. Credit card cash back is what we're talking about here. One of the numerous financial planning podcasts I viewed earlier this week had, I'm not going to mention his name, but another guy who kind of preaches heavily against using any kind of debt whatsoever. And one of the speakers on this show gave an example of somebody who makes $45,000 a year. So, and we assume that this guy had a credit card, and the objective of this particular sample person was to use it to maximize his reward. So, based on that amount of spending, this guy basically said, well, you're going to make maybe $500 a year in possible rewards. Well, I'm kind of looking at a few here. So these are some more popular. These are the best cashback free cashback cards that are out there right now, based on this CNBC study. Looked at a few of them. I'm not going to go through all the details, but some are 1.5% cash back, but most others have different bonus structures that are out there if you use it more for groceries or gas or whatnot. So the 2% number, I guess as a general rule, is probably okay to use, but I think with a little bit of work, you can squeeze a little bit more out of this thing. And just going back to looking at my own personal example here, have a business card that I use for every single thing I can put on a possible business. I pay it off every week. I got a personal card I do a similar thing with, and over the past probably 3 months, since back in February, and really started kind of paying closer attention to it, I've generated a little bit over $200 worth of cash back rewards on both of those cards that I've been dumping into my brokerage account. So it takes a little effort, right, to make sure that you are paying attention to the due date, so you're paying the balance down before the statement closes, so it doesn't hit your credit report. Of course, being careful you keep the thing paid off, so you don't generate any interest charges, which would wipe out all the benefits of the plan here. But that extra little bit of effort got me a few $100 of money in my brokerage account. So I'm doing that $25 a week deal with E-Trade, where they're buying a fractional share. So I'm watching that kind of grow, and the first go around it wasn't much, and it's just strictly based on credit card points, and I think I put maybe $50 in an account. So this one particular section of my investment portfolio is nothing but credit card rewards dollars. So first first dividend payment that came in was only a few pennies, whatever. After that, it built up a few more shares, and a couple bucks came in, and we'll see how it goes the rest of the year. But and so that's just an example of something I think is pretty easy for people to do. So I guess so the easy answer is don't have credit cards and just pay everything off and whatever. But with a little bit of effort, you can squeeze a little bit of money out of the system here that the banks are going to make anyway. And if you're careful about how you utilize that, you can increase your own net worth with this. So I think as we watch that investment portfolio grow, I'll probably maybe pull up some graphs next time we talk about this topic. But it seems pretty clear to me that that's not quite a passive, but about as close to passive investment as you can. Milking those rewards out of there and dumping it into my passive income account. So there's that. This week, we're chock full of conversations, but our other chat here is this infinite banking idea. So comes up from time to time, and in general, I'll mention what infinite banking is. This involves you buying a whole life or a universal life, or one of the permanent types of life insurance. And those insurance policies have a cash value component in addition to the premium. So in this little graph here, kind of the way it all flows through is you put some money into a policy, and you have a death benefit. So right off the bat, they're taking some money out to cover the cost of that death benefit, but the remainder builds up in this protected tax-free in most cases account. So they invest it in various choices there, but the most common example is this fixed investment with an insurance company. Throws off somewhere between 3 and 5% of an annual dividend rate that gets reinvested back in a policy. So your cash value is built up. So this cash value can be used to continue to pay your premiums. So as you get older and those premiums ride, it's kind of helpful to have that accumulating, because it will pay for the policy when the things are really pricey. But another option with this infinite banking here is where the person pulls money out of the policy. So it takes that cash value and borrows it to buy a house or whatever these things are here. But so you can do whatever you want with it when you kind of take it out. So I guess the you do have to make payments on it, but your principal still continues to compound at the original rate. So it's not like you pull the money out of account and your investment goes down. So the principal is considered to still be in the policy. It still grows at whatever interest rate the insurance company gave you when you got the policy. And it seemed like on its face you'll see it. I think it's probably oversold, but you'll see it talked about quite a bit. It's not good for everybody, but it is not a bad idea in some cases. So I guess when you have your Roth IRAs and all your other bases kind of covered, this is probably one of the last things I would consider adding to my portfolio for these reasons here. So we talked about the pros of it. So yeah, the growth, so you borrow money to take out, it continues to grow. So yeah, that's obviously a plus. Guaranteed loan option, so you don't have to worry about your credit score or anything, because this is pretty much guaranteed by the cash value of the policy. So it's a slam dunk that you're going to get approved. No tax on it, so you pull money out of policy. It's not like you're cashing in some other kind of investment where you might have some capital gains to worry about. And you have some built-in protection. So these type of policies, check your own state, but in most states there's creditor protection. So something happens, your cash value in a policy as well can't be touched. So I guess if you borrow money and you go buy a house, I guess that could still be at risk. But the policy cash value itself is protected, similar to like retirement accounts and things like that. So that's a plus. However, the downside is that you have limited liquidity in early years. So it takes a few years of paying this premium in order for the cash value to grow to a substantial enough amount that borrowing it makes any sense at all, right? So if it's in year one, the big chunk of the money goes to the insurance costs and the admin costs. You might if you have a $10,000 annual payment, which is low, you'd be lucky if $1,000 ends up hitting the cash value account in a case like that. So it takes a while for it to build up some liquidity, so you can't immediately use it. And once you do take out a loan, you do have to make mandatory annual payments. So you got to make payments on a loan, as well as the premium. So as time goes on, you're always going to have to make these premium payments or risk the thing lapsing. So that's something that they didn't really mention here. But I have heard of some horror stories where a loan's taken out, the cash value, even though it's supposed to still be there, it's kind of really not there, available to pay premiums. So ordinarily, if you miss paying a premium, it's not a huge deal, because if the cash value is sufficient, the cash value just kicks in and covers it for you. However, if you've taken a loan out and something happens and you can't make your annual premium, now you potentially have a problem, right? So if that policy lapses, it's no longer protected, it's no longer a loan, everything falls apart, you got tax problems and everything else. So that annual payment, the annual commitment to paying money into the policy, has to go on forever. So that's why I don't like this as a first option. This is the kind of thing to do after you have all your bases covered, and you've got a solid enough investment portfolio, your retirement accounts are solid, you got some rental properties. This is why I would look at this last, and make sure all those other bases are covered first, because this could be bad. I've heard of cases where the policy lapses. Also, the fact that it happens tend to happen later in life. The insurance component can be very, very expensive. So in a case where things about to lapse, you might get a notification from the insurance company. On a case like $1 million policy, might have 10, 12 grand of premiums. You might all of a sudden find yourself 30 years down the line having to make a $40,000 payment to keep the face value of the death benefit all in place and keep it active. So that could really blow up the rest of your plan if you're not substantially liquid everywhere else. But health and financial qualifying, so that's another issue there. If you are in poor health, the insurance cost gets to be kind of prohibitive, and then all your payments get eaten up by the insurance costs, and not much goes to the cash value. So another possible hiccup there, and just ongoing discipline. And it kind of goes back to the mandatory payments thing here. So be careful. I've seen these pretty slick sales presentations on this topic, and nothing's always perfect. So definitely think about it. Talk to somebody who knows what they're doing if you're considering it. And so that's that. So my closing thoughts for the week here. Saw something pop up today, a quote from Mark Twain. It says, "I do not fear death. I had been dead for billions and billions of years before I was born, and had not suffered the slightest inconvenience from it." So Yeah, so I'm thinking about just how sometimes we get stressed out about I don't know what people think of us and reputation. But at the end of the day, we're only here for a very short blink of an eye, I guess, as far as time goes in the grand scheme of things. And we'll be dead for a long time before, we'll be dead a long time afterwards. So maybe don't worry about things so much, and live your life, be a good person. But I guess don't kill yourself too much about this reputation or what others might think of you. Doesn't matter. So with that, guys, have a great weekend, and we look forward to seeing y'all here again next week. Bye.